all I can tell you is I think Bitcoin is extremely cheap on a number of metrics. And I'm comfortable buying it at 30,000 because I think that it is so darn cheap. And, you know, I use one model that uses credit default swaps. I can use another model that values Bitcoin at over $2 million in today's dollars.
According to Greg Foss, an influential advocate for Bitcoin and the executive director of strategic initiatives at Validus Power Corporation, there is a strong likelihood that Bitcoin will become a multi-trillion-dollar asset class in the near future. Foss argues that several metrics support the notion that Bitcoin is currently undervalued, such as pricing everything in Bitcoin, including fiat currencies like the US dollar, and using Bitcoin as credit default swaps against sovereign debt. Another compelling metric is Bitcoin's small share of the total global financial assets, which is just a tiny percentage compared to the $900 trillion total. Foss predicts that as more people diversify away from other asset classes like bonds, Bitcoin's market cap will rise significantly, potentially reaching a value of $2 million per coin. In a recent interview with Kitco News, Foss also discusses his views on fiat currencies and their inevitable debasement. He highlights the United States dollar as an example of a reserve currency that has continuously lost its value over time. In contrast, Foss praises Bitcoin as the world's best store of value, based on its mathematical and code-based properties that are immune to manipulation by any central authority. He believes that Bitcoin will outlast all fiat currencies and deliver superior long-term performance.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
So I can use another model that values Bitcoin at over $2 million in today's dollars.
Is that going back to bonds?
It is bonds, and it's global financial assets, of which the largest global financial assets is debt. So yes, it rests on the debt thesis, but you have debt, then you have real estate, then you have equities, all summing up.
Break that down for us.
Sure. The total global financial assets in the world today are 900 trillion US dollar equivalent, okay? Which includes global financial debt, 400 trillion US dollars. Right below that, 300 trillion of global real estate. Below that, 100 trillion of global equity. And then there's a catch-all bucket of another 100 trillion, which includes your gold, which is anywhere between $5 and $10 trillion. It includes commodities. It includes all currencies. So adding it up, 400 plus 300 plus 100 plus 100, that's your $900 trillion of total global financial assets, okay? That's your addressable market for Bitcoin, measured in US dollar fiat today. Let's play some games. What if Bitcoin gets a 5% market share? 5% of 900 trillion, 45, do the math, 45 trillion, right? What's 45 trillion divided by the fixed supply of Bitcoin of 21 million? Over 2 million US dollars per Bitcoin in today's dollars. I don't care about anything else. I own Bitcoin for the next 20 years. If you ask me how it gets to my price target, I don't care.
How does it get to 5% of total?
Because it's the world's best store of value based on math and code that cannot be manipulated by any centralized authority. Start at 1%. Because right now, it's at $500 billion, or $0.5 trillion on 900 trillion in total. Gosh, it's so minuscule, and it could be so huge.
Let's focus on this idea that you said all fiat is programmed to debase.
Yes. It starts with the debt spiral, right? The only way to solve this spiral is by what's called an error term. You can't possibly generate the tax revenues to keep up with the organic growth of the debt spiral. That means you have to plug the equation. Otherwise, the left-hand side of the equation doesn't equal the right-hand side of the equation. So when that happens, you have to plug it with an error term. I call the error term printing money. Let's talk about the debt ceiling quickly. It is political theater. How many times has it bumped up against the limit and then they fix it only to come back to have to adjust the limit down the road? Now look, I'm betting, it's not certain, but most likely that they do solve the current debt fiasco.
But we're going to printing. I mean, that's
that's fair. Yeah. But they have to be able to print. Essentially, yeah. Here's the flip side. We're going to be back at the table in less than 8 months because $1.5 trillion will do nothing, because that'll get used in less than 6 months. So we're going to be back at the table in less than 6 months, negotiating another increase in the debt ceiling. Ridiculous.
While Greg Foss's calculations may have a slight margin of error, his assertion that we will find ourselves back at square one discussing the debt ceiling issue is entirely accurate. President Joe Biden recently signed a bipartisan agreement to suspend the debt ceiling debate until January 2025, which means that in about 18 months, we will once again be facing the debt limit dilemma. This recurring debate does not bode well for the dollar, particularly at a time of great uncertainty. Larry Fink, the CEO of BlackRock, the world's largest asset manager, also expressed concerns about the dollar's reserve currency status, stating that the frequent debt ceiling drama undermines the United States' position as a global leader. In his discussion with McCary, Foss echoes similar sentiments as he shares his perspective on the United States economy, bonds, and the banking crisis. The interview provides further insights into Foss's views on these topics.
Look, I spent my entire career in bonds. Bonds make sense at a certain price. They just don't make sense at today's price, given where inflation is, but more importantly, where fiat debasement is, because bonds are a fiat contract. Don't ever forget, a bond is a fiat contract. And if it's priced in something that's debasing, I'm not arguing that it's highly likely that you get your $100 back. You lend to the USA $100 today for 10 years. It's highly likely, not certain, that in 10 years you get your $100 back as well as the contractual payments of interest. The problem is, in 10 years, that $100 is worth $60 because of fiat debasement. Yeah, it's not a great investment because everyone runs the math as I invest 100 and I get 100 back and I get my coupons, and that's called a yield to maturity. But they assume that the value of $100 in 10 years equaled the value that it was today.
So not taking into account
debasement, correct,
and inflation.
They're the flip side. They're the same thing. But at the end of the day, yes, you're absolutely right. Now look, a bond is what's called a soft asset. And there are other hard assets. I know you like gold and real estate and Bitcoin. That's why I like being on your show. Because I'm not saying you have to put all your money in Bitcoin. But be careful of soft assets, which are bonds, versus hard assets that maintain their purchasing power against fiat, like real estate, like gold, like equities. Amongst those three, bonds are the worst. Now, in a short-term trade, guys can say, hey, interest rates are going to go down, therefore bond prices are going to go up. That's a trade. That's not a 30-year investment. I'm talking 30-year investment horizon.
Last time we spoke was right after Fed Chair Jerome Powell tried to assure us that the banking system was, quote, sound and resilient. Calm before another storm?
In my opinion, yes, only because banking is banking. The reality is banks are very levered. They always have been. And when you are very levered, which is to say that their capital base is only 4%, plus or minus, to their total asset base, that 4%, which is your protection, can get vaporized very quickly, which means banks are frequently insolvent. And having worked at the largest financial institution in Canada in 1988 during the Latin American debt crisis, we talked about different crises that I've been to, the Royal Bank of Canada was insolvent in 1988, but it was no different than Chase Manhattan and Manufacturers Hanover and Bankers Trust in New York, because the value of their loans, the Latin American loans, had fallen by so much that the equity value, the risk-absorbing equity in the bank, was vaporized. That's not healthy, but it is the fiat system. That's how it works. You know, did you see that UBS, which rescued Credit Suisse, is complaining that they said we were forced into this deal?
Yeah.
Well, they still did it.
Free market, yeah.
They still did it.
Yeah.
JP Morgan may be the last bank standing. Now, I agree. First of all, Jamie Dimon is a very good banker, but that's like saying, you know, you're the best of a very bad bunch, right? Like, banking is extremely risky, and he's a very good risk manager, but when you're dealt a hand that has 25 times leverage in it, which is what a bank is, it's very hard to thread that needle all the time. 25 times leverage, to be clear, is your 4% equity capital on $100 or 100% equity base. 25 times 4 equals 100. That's your 25 times leverage.
When questioned about central bank digital currencies, Greg Foss expressed a distinct perspective compared to other prominent Bitcoin advocates. As a former risk manager, Foss believes that CBDCs will have a positive impact on the growth and development of Bitcoin, particularly in the United States. Contrary to concerns that CBDCs might hinder Bitcoin, Foss sees them as an opportunity to educate millions of investors about the leading cryptocurrency. He believes that as people become disillusioned with the control and manipulation inherent in CBDCs, they will be more inclined to invest in Bitcoin, which offers the benefits of CBDCs without any centralized control or manipulation. If you have any thoughts or observations regarding Foss's discussion with McCary, feel free to share them in the comments section below. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.